Welcome back to the deep dive. It is Wednesday, January 28th, 2026. And today we are looking at something pretty monumental. This isn't just another quarterly report.
No, not at all.
We are looking at what might be, and I don't think this is an exaggeration, the single most significant changing of the guard in the history of the tech industry.
It really feels that way.
We're looking squarely at Meta Platforms, the company we all used to call Facebook.
Right.
And their Q4 and full year 2025 earnings release just dropped a few hours ago.
And I've been going through it, and let me tell you, it feels like the ground is literally shifting under our feet.
How so?
This isn't just about ad impressions anymore or, daily active users. That's the old story. We are witnessing one of the most radical pivots in corporate history, and it's happening right now in real time.
It really does feel that way. I mean, think about the narrative we've all had for the last 15 years. For over a decade, we thought of Facebook and then Meta as this ultimate software money printer.
It was the dream business model, wasn't it?
Absolutely. You build the code once, maybe in a dorm room, you ship it to billions of people for basically nothing. And the margins are just astronomical because you don't have to build factories or ship physical boxes. But the signal we got today, it suggests that whole era is dead.
Completely dead. I think you're right. The entire narrative has flipped on its head. They are morphing from a capital-light software business into a capital-heavy industrial utility.
That is a heavy phrase, industrial utility. That sounds old, like railroads or something.
It's the only way to describe it, though. It's not just about writing clever code anymore.
No.
Now it's about pouring concrete. It's about securing nuclear energy permits. It's about buying silicon at a scale that, frankly, rivals what entire countries do.
So they're becoming something closer to an electric company than the social network we grew up with.
That's a perfect analogy.
So, okay, our mission today is to try and parse these conflicting signals. Because on one hand, we've got record revenue. I mean, absolute blowout numbers.
Right. The top line looks amazing.
But on the other hand, there's this massive, just eye-watering spending that makes you really question the sanity of the whole balance sheet. We need to decide. Is this a visionary bet on artificial general intelligence that's going to secure their dominance for the next 50 years? Or is Mark Zuckerberg just digging a reckless money pit that's going to incinerate investor capital?
That is the trillion-dollar question.
Yeah.
And I think you're right to frame it that way. It feels like a binary outcome.
Oh.
There's not a lot of middle ground here.
Okay, before we get into the numbers, and wow, there are a lot of numbers to get through, we have a quick tool for now. To keep a pulse on the broader market while you're listening to all this. To track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store. It's a great way to see if the market's general mood matches the craziness we're seeing in these earnings.
And as always, we have to do our necessary reminder before we really dive into the weeds on this.
Of course.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Please conduct your own due diligence before making any investment decisions.
Absolutely. And finally, if you want our full deep dive on this or access to more of our advanced content, welcome to join the Deep Value Club membership, or you can subscribe to us on Apple or Spotify podcasts. The channel is Deep Value Investing and deepvalues.ai.
We've got the full valuation models we're going to touch on today available for download there.
Great. Okay, let's get into the meat of this. The headlines are flashing everywhere right now. What is the top line story? What's the first thing people are seeing?
The headline story is pure, unadulterated growth. I mean, if you're just a surface-level investor and you only look at revenue,
right, the
machine isn't just humming, it is roaring.
Yeah.
For the fourth quarter of 2025, revenue hit $59.89 billion.
59.89. Let's just call it 60 billion.
Basically 60 billion. And that is up 24% year over year.
Okay, let's just pause on that for a second. 24% growth. For a company of this size, I mean, we are talking about one of the largest companies on the planet. To grow a quarter by almost 25% is just...
It's massive.
It's mathematically difficult to do that at this scale. Normally, the law of large numbers kicks in and everything just slows down to a crawl. But they're defying gravity somehow.
They are. And for the full year, for 2025, they crossed a huge psychological milestone. Revenue came in at $200.97 billion.
$200 billion.
$200 billion, exactly. And just to give you some context on that, that's up 22% from 2024.
So what this proves is that despite all the talk about a slowing economy, all the fears of a recession in 2026, the core advertising business, the engine that pays for absolutely everything else, it's still a monster.
It's effectively printing money.
So the revenue is fantastic, top line looks beautiful, but when I was looking at the profitability numbers, things started to get well, weird.
Yes.
The operating margin dropped, and the tax rate looked incredibly high. I think a lot of our listeners might have been confused by that. What in the world is going on there?
Right. And this is where we really have to separate the signal from the noise. It's so important.
Okay.
If you just look at the raw GAAP numbers, the standard accounting numbers, you might think profitability is just collapsing.
Which is what I thought at first glance.
But you have to account for the specific legislative landscape of 2025. Specifically, you have to understand the One Big Beautiful Bill Act, or OBBB. The OBB, right? This was that massive omnibus legislation that got passed back in Q3 of 25, wasn't it?
That's the one. It was a huge sweeping tax reform bill. And that act caused massive accounting noise for big corporations like Meta.
How so?
Specifically, it triggered a $15.93 billion one-time non-cash income tax charge. Okay, hold on. Let's unpack that so everyone can follow along. $16 billion just vanished from the bottom line.
Toof. Gone.
But you said non-cash. What does that mean in simple terms?
It means they didn't literally write a check to the IRS for $16 billion yesterday.
Got it.
It's an accounting adjustment. It's based on the value of assets they held for tax purposes, called deferred tax assets. But because of accounting rules, they have to report it as if it were a loss on their income statement this quarter.
That is not small change. $16 billion is more than most companies on the S&P 500 make in a lifetime.
It's a huge number. And it completely skewed the reported effective tax rate for the full year. It made it look like it was 30%.
And normally for a tech company, it's what? Much lower?
Much, much lower. Historically, a company like Meta pays something in the neighborhood of 15% to 17%. If you strip out this specific OBBB charge, their effective tax rate for the year would have been around 13%.
13. So a massive difference. So if I'm an investor or just someone trying to understand the real health of this company, I should basically just ignore that charge, pretend it never happened.
You have to normalize for it, yes.
Yeah.
If you want to know the true earnings power of the business, you absolutely have to strip out that one-time tax bill.
And if you do that, what does the profit look like?
Well, if you do that, the net income wouldn't be the reported $60 billion. It would have been approximately $76 billion.
76. Wow, that is a massive difference in perceived earnings power.
It's a completely different story.
So the underlying engine is actually significantly healthier, maybe 25% healthier than the headline profit number would suggest.
Much healthier. The business is generating cash at an absolutely incredible clip. But, and this is the big but of this entire deep dive,
Here it comes.
management isn't hoarding that cash. They aren't just putting it in T-bills and letting it sit there.
No.
They are about to spend it. All of it. And then some.
And this brings us to the part of the report that I think made everyone's jaw just hit the floor.
The guidance.
The guidance. We're not just talking about a little increase in the R&D budget here. We are talking about what you could only call a CapEx shock.
Shock is exactly the right word. I mean, when the CFO read this number on the earnings call, you could almost hear a pin drop across Wall Street.
So what was the number?
Management forecasted their capital expenditures, their CapEx, for 2026. They are guiding for a range of $105 billion to $117 billion.
Hold on. Just let me repeat that slowly so it sinks in. Over $100 billion.
Yes.
In one single year on buildings and machines.
That's right.
To put that in perspective for everyone listening, how does that compare to what they used to spend?
Well, let's go back to 2023. That was the famous year of efficiency.
Right, when they were cutting costs and laying people off.
Exactly. They spent roughly half of that. And then in 2025, they ramped up to about $70 billion, which everyone at the time thought was crazy high.
And now they're almost doubling it again.
Now they're stepping on the gas to hit almost $120 billion. I mean, that amount of money. It rivals the entire GDP of some small nations.
That's an incredible thought.
It is an unprecedented level of infrastructure investment for a single tech company. It's more than ExxonMobil spends digging for oil around the entire planet.
Where is all that money possibly going? Are they literally buying a small country?
In a way, they're building a digital one.
Okay.
The vast, vast majority of this is going into two main things: AI training clusters, and then all the physical infrastructure you need to support them.
AI training clusters, so we're talking about GPUs.
We're talking about buying the absolute next-generation NVIDIA GPUs, the B200 and the B300 series.
These are the successors to the Blackwell chips.
Exactly. The most powerful, most power-hungry chips on Earth. And that's not all. They're also manufacturing their own custom silicon, their MTIA chips.
And what are those for?
Those are specifically designed to handle the workloads for their recommendation algorithms, you see in your feed.
And all those chips need a place to live. You can't just put these in a closet in Palo Alto.
Exactly right. And you can't just plug them into a standard wall outlet. They consume massive amounts of power, and they generate massive amounts of heat.
So data centers.
Massive new data centers. The report specifically called out a new facility being built in Richland Parish, Louisiana. And these aren't just warehouses with a bunch of servers in them anymore.
Oh.
These are gigawatt-scale facilities.
Gigawatt scale. That's power plant language.
It is.
See?
And that's why they are actively investing in nuclear and renewable energy sources. Not for PR, but just to power the cooling systems and the processors for these things. They're literally becoming energy brokers.
This feels like a fundamental structural shift for the entire company. We used to talk about Facebook as this beautiful, high-margin, asset-light business. The whole idea was just write code.
That era is over.
Yeah.
This is, I think, the most crucial insight from this entire quarter. Meta is no longer a software company with 80% margins. Not in the traditional sense.
It's becoming
An infrastructure utility.
an infrastructure utility, like Con Ed or a water company.
Think about it. When you build a utility, what's your biggest expense? It's not your people, it's your equipment.
The power plant itself.
Exactly. It's depreciation. You build a power plant, it costs you billions, and you write off the cost of that plant over, say, 20 years. Meta is now doing the exact same thing, but with servers and GPUs.
So depreciation is becoming their biggest line item.
Depreciation is replacing cost of goods sold as the primary weight on their income statement.
So for the listener, what that really means is the economics of the entire business are changing. It's getting way more expensive to make $1 of revenue because you have to buy the machine first.
That's it.
Yeah.
It's a huge upfront cost. And the market is looking at this in a very binary way. There are two camps forming around this stock right now.
Okay, what are they?
Camp 1 says, this is unnecessary moat widening. It's brilliant.
A moat widen.
Yes. The thinking is, if they don't spend this $100 billion, they lose the AI war, their ad targeting gets worse, user engagement drops, and eventually they just die.
So it's survival.
It's survival of the fittest.
And what's Camp 2?
Camp 2 has a much scarier name for it. They call it profitless prosperity.
Ouch. That sounds painful.
It's a terrible concept for an investor. The idea is that, sure, revenue will keep growing, but the free cash flow, the actual cash the owners of the business get to keep, it's going to evaporate.
Why?
Because they have to keep buying these incredibly expensive hardware upgrades every single year, every 2 years. It's a treadmill you can never get off of. You have to run faster and faster just to stay in the same place.
That is a scary thought. But, okay, let's look at what's fueling this treadmill. We established the revenue is growing like a weed. Where specifically is it coming from? Is it still all just Instagram ads?
It is overwhelmingly the family of apps.
So that's Facebook, Instagram.
Facebook, Instagram, Messenger, WhatsApp, and now Threads. That whole segment generates 97.8% of their total revenue.
97.8%. So for all the talk about the metaverse and AGI, this is still an ad company.
At its core, it is the cash cow that funds everything else.
Right.
Reality Labs, the VR and AR stuff, that only contributes about 1.1% to the top line.
1%. It's basically a rounding error.
A very expensive rounding error. And the other category, that's things like the WhatsApp Business API and the Meta-verified blue check subscriptions, that's growing fast. It's up 59%. But it's still very small dollars in the grand scheme of things.
And what about the users? I feel like for years we've been hearing people say, oh, Facebook is dead, or nobody uses it anymore, especially not young people.
The data just doesn't support that at all. As of December 2025, they hit 3.58 billion daily active people.
3.58 billion. That is nearly half the entire human population.
Every single day, using one of their apps. That is the inventory that Meta sells to advertisers. They are selling the attention of half the planet. And here's the magic formula that happened with that inventory this quarter. In Q4, the number of ad impressions, so the number of ads they actually showed, went up by 18%.
Okay, so more volume.
More volume. But at the same time, the price per ad went up by 6%.
Now, that's the holy grail, isn't it? I mean, usually in Economics 101, if you flood the market with supply, if you increase volume by 18%, the price should crater.
Exactly. The laws of supply and demand say the price has to go down, but they're defying that. It's incredibly rare to see this kind of price times volume growth, especially at this kind of scale.
What does that tell you?
It shows they have immense pricing power. And it shows that their AI, the Advantage plus ad targeting tools, is really, really working. Advertisers are willing to pay more for each ad because the ads are converting so much better.
So this brings us to the whole idea of the moat. Why are they so hard to kill? I mean, we've seen powerful challengers like TikTok, we've seen Snap, but Meta just keeps getting bigger and more profitable.
That's what I call a triple layer moat now.
Okay, layer one.
Layer one is the classic one, network effects, the social graph. Leaving Facebook or Instagram just painful because that's where all your memories are. It's where your friends are. That hasn't really changed.
Right. You leave, you're basically in a digital ghost town.
You're alone. Layer 2 is the data advantage. This has become even more important since Apple changed their privacy rules a few years ago.
The app tracking transparency thing.
Right. That made first-party data king. And Meta knows more about what you click on and what you like than anyone else because you're doing it inside their walled garden. They don't need Apple's permission to see what you just liked on Instagram.
Makes sense. And the third layer?
The third layer is this new one we've been talking about. It's compute scale.
The $100 billion spending spree.
Exactly. By spending that much money, Meta is erecting a barrier to entry that is almost insurmountable for anyone else.
Because nobody else can afford to play the game at that level.
Precisely. There are maybe, 2 or 3 other companies on Earth, Microsoft, Google, maybe Amazon Web Services. They're the only ones who can even think about spending $100 billion a year on silicon.
So if you're a Snap or a Pinterest?
If you're Snap or Pinterest or some hot new startup, you simply cannot afford the compute power needed to train the AI models that make the ads and the content feeds relevant. You get squeezed out by raw, brute capital force.
So in a weird way, the CapEx shock is actually a defensive move. It raises the stakes of the game so high that all the smaller players just have to fold their cards.
That is the bull case in a nutshell. They're spending their competitors into oblivion.
But it's not all smooth sailing. I mean, we have to talk about the risks. And there's one risk that has a very specific and very expensive name, Reality Labs.
Ah, yes. The metaverse bet. The elephant in the room.
We mentioned it's only about 1% of their revenue, but what is it doing to the bottom line?
It is bleeding cash. Aggressively. Reality Labs is still losing approximately $15 to $20 billion annually.
15 to 20 billion every year. That's just gone. Incinerated.
Vaporized. And if you look at the cumulative investment, since they really started this big pivot into the metaverse, it is approaching $100 billion.
That is a staggering amount of capital poured into something with so little to show for it on the revenue side.
It's historic. And the risk here is just incredibly simple. Unless virtual reality and augmented reality become the dominant computing platform of the 2030s.
Unless we're all walking around wearing Ray-Ban meta glasses in 5 years.
Exactly. Unless that happens, this will go down in the history books as one of the largest single destructions of shareholder value in corporate history. It's a completely binary bet.
It's the money pit that Camp 2 was talking about. But that's an internal risk. What about the external threats? I know Europe in particular has been a real thorn in their side.
Europe is a major, major headache for them. The EU's Digital Markets Act, the DMA, is fully in force now.
And what does that do?
It is forcing Meta to offer less personalized ad options to all of their European users. Basically, you can opt out of the deep tracking.
Which means the ads they show you are dumber, and therefore they're worth less money.
Exactly. If I can't target you based on your specific granular behavior, I can't charge the advertiser as much money for that ad spot. It degrades the average revenue per user in one of their wealthiest markets. It's a permanent drag on their efficiency.
And what about here in the U.S.? Are the regulators just leaving them alone?
The FTC is still lurking in the background. They are still actively pursuing the antitrust case to try and break up Instagram and WhatsApp from Facebook.
Is that likely to happen?
Most analysts view a full breakup as a pretty low probability event at this point, but it's a tail risk. It's a non-zero chance. It just hangs over the stock like a dark cloud.
And of course, we can't forget the broader economy.
Right. Macro sensitivity. Meta relies on about 10 million active advertisers. A huge chunk of those are small and medium-sized businesses.
The local coffee shop, the person selling things on Etsy, the local plumber.
Exactly. And if the economy really slows down in 2026, if we actually hit a meaningful recession, ad spend is the very first thing those small businesses cut from their budget.
So Meta is really a proxy for the health of the global economy.
It's a great barometer for it.
So, okay, we have this money-printing machine in the ad business, we have this money-burning furnace in Reality Labs, and we have this wall of regulators trying to chip away at them. Who's the person steering the ship through all this?
Well, it's Mark Zuckerberg. And I think steering is probably too light a word. He is commanding it. He's directing it with an iron fist.
And he has total control, right, because of the share structure.
Total. He controls roughly 61.2% of the voting power. He cannot be fired. He cannot be overruled by his board. He is operating in what Silicon Valley is now calling founder mode.
Founder mode. I've heard this term more and more recently. It basically means you ignore the short-term noise from Wall Street and just do whatever you want, right?
That's essentially it. It means ignoring Wall Street's incessant demand for smooth, predictable quarterly profits in order to build a long-term, world-changing vision.
And his vision is AGI and the metaverse.
Correct. He is willing to stomach a $100 billion CapEx bill because he believes he is building the fundamental infrastructure for the future of AGI. A hired CEO, a professional manager, would have been fired 3 years ago for this level of spending. But Zuck answers to no one but himself.
And he's reshuffled the deck around him, too. The board of directors looks pretty different than it did just a year ago.
Very different. The changes that were made back in January of 2025 were extremely telling. I think the most headline-grabbing addition was Dana White.
Dana White, the CEO of the UFC.
One and only.
That seems like a very unexpected choice for a tech company board.
It is, but it's incredibly strategic. It signals a major shift in the company's culture.
In what way?
Dana White connects Meta to the young male demographic and this entire alternative media ecosystem, podcasts, YouTube, the so-called manosphere.
A demographic that Meta has been losing to TikTok and other platforms.
Badly. It's also a bridge to the political right and potentially the incoming U.S. administration. It's a statement. It says that Meta isn't playing by the old, polite, coastal corporate rules anymore.
That is fascinating. It's a cultural signal as much as it is a business one. Who else joined the board?
John Elkann.
Well,
he's the CEO of Exor, which is the holding company that controls Ferrari and Stellantis. Chrysler, Jeep, Peugeot.
So big, heavy industry. Cars, steel, manufacturing.
Deep industrial experience. If you were going to become an infrastructure utility, you need people on your board who understand heavy industry, not just people who understand software. You need guys who know how to build factories.
And he's European, which must help with the regulatory stuff we just talked about.
A huge help with navigating Brussels.
And there was a third name, wasn't there?
Charlie Songhurst. He's a deep tech strategist, formerly a key player at Microsoft. He's on the board for the AI roadmap to make sure the strategy is sound. So you have a board that is now built for 3 things: culture war, industrial scale, and AI strategy.
It sounds like a wartime board.
It absolutely is.
But speaking of culture, it hasn't all been smooth. There have been some pretty serious integrity issues raised in this latest report.
Yes, there are ongoing whistleblower allegations that are pretty disturbing. Specifically, they're coming out of the VR division, out of Reality Labs.
What's the claim?
The claim is that the division actively suppressed internal research on child safety in order to prioritize user engagement and growth metrics.
That sounds depressingly familiar. It's the same story we heard about Instagram and teen mental health years ago.
It is a recurring and very troubling theme, and the shareholders are noticing it. There was a shareholder proposal on the latest proxy regarding anti-Semitism and hate speech monitoring.
Did it pass?
No, of course not. It couldn't, because Zuckerberg controls the majority of the vote, but it received 46.8% support from independent shareholders.
Wow. That's nearly half of all the independent investors basically saying, we're not happy with how you're handling hate speech and content moderation.
It is a significant protest vote. It shows that while investors obviously love the profits from the ad engine, they're getting very wary of the governance structure and the broader social impact of the company.
Okay, let's get down to brass tacks then. Let's talk about the valuation. After all this, is the stock cheap?
This is where it gets really, really tricky. We like to use what we call the guru tracker.
The guru tracker? Who are the gurus in this case?
We look at famous dyed-in-the-wool value investors, people like Li Lu and Monish Pabrai. They were buying Meta heavily back in 2020, and especially in 2022 when the stock was just beaten down and left for dead.
A smart move in retrospect. Are they buying it now?
No. They sold out in 2022, and as of their latest public filings, neither one of them has re-entered the stock. They're sitting on the sidelines.
That's a huge signal in and of itself. They don't see the deep, obvious value anymore.
Exactly. And when we run our own valuation models, we start to see why. Let's look at it 2 ways. First, the discounted cash flow model, or DCF. If you believe the AI utility thesis, if you believe all this spending is going to pay off handsomely in the future, our model suggests a fair value of somewhere around $690 to $710 per share.
And the stock is trading today at around $672.
So according to that model, it's fairly valued. It's not a screening bargain, but it's not wildly overvalued either if you believe the AI bet works out. It's priced for success.
But there's another, maybe tougher way to look at it, right? The classic value investor view.
The Warren Buffett view, using a metric called owner's earnings. And this paints a much, much harsher picture.
Can you walk us through that math? Explain it in a simple way.
Sure. Owner's earnings is basically trying to answer one question. How much cash can I, the owner, take out of this business each year without hurting its long-term competitive position?
Okay.
So you start with that adjusted net income we calculated earlier, the $76 billion.
Yeah.
Then you add back depreciation, which is about $20 billion, because that's a non-cash expense.
Got it. So we're at $96 billion.
Right. But then, and this is the absolute kicker for a company like Meta right now, you have to subtract what we call maintenance capex.
Maintenance capex. So that's the cost just to keep the lights on and stay competitive, not the growth stuff.
Exactly. With this massive infrastructure build, We estimate that their maintenance capex alone is around $35 billion a year. You have to spend that much just to keep the servers from falling apart and to replace old chips.
So 76 billion plus 20 minus 35.
Gives you owner's earnings of about $61.4 billion.
And when you compare that to the company's total market cap,
it means the stock is trading at nearly 28 times owner's earnings.
28 times. And a traditional value investor usually wants to pay what?
Less than 15, ideally something closer to 10 or 12.
So from that perspective, it's very expensive.
It is expensive. It is priced like a high-growth, speculative tech stock, not like a mature, cash-gushing value stock.
What about the share buybacks? I saw in the report they're buying back $20 to $30 billion in stock. Doesn't that help the shareholder?
It helps a little, but you have to look at why they're buying it back. A huge chunk of that 20 or 30 billion is just being used to offset dilution.
Dilution from what?
From stock-based compensation. They are hiring thousands and thousands of incredibly expensive AI engineers, and they're paying them largely with stock options. The buybacks are just soaking up all that new stock so that the total share count doesn't explode.
So it's not really returning capital to me, the shareholder, it's just paying the employees.
You're just treading water on the share count.
Okay, let's try to pull all of this together. We have unpacked a lot of information here.
We definitely have.
So what does it all mean at the end of the day? We seem to have a company that is, at its core, a paradox.
It is the ultimate paradox. On one side of the ledger, you have the world's most profitable advertising utility. It is a cash cow that simply works day in and day out. And on the other side, you have a speculative trillion-dollar science project to build artificial general intelligence from the ground up.
And that year of efficiency that we all heard so much about in 2023 and 2024?
It's dead. It's buried. We have now officially entered the investment supercycle.
It really feels like a completely different company than it was even 2 years ago.
It is. And here is the question that I really want to leave our listener with, the one to chew on.
Go for it.
Meta now has a $100 billion annual infrastructure budget. It is actively striking deals for nuclear power. It has a daily active population of 3.5 billion people. That's larger than China and India combined.
Right.
It is, in effect, issuing its own currency credits, stars inside its own digital ecosystem.
Okay, so where are you going with this?
At what point does Meta cease to be a company in the way we traditionally understand it and instead become a sovereign digital nation? And if it is a nation, does our standard stock valuation toolkit, price to earnings, discounted cash flow, does any of that even apply anymore?
Yeah.
Or are we really trying to value a GDP?
That is a very heavy thought. A digital nation with Mark Zuckerberg as its unelected permanent monarch.
Precisely.
Well, on that slightly terrifying note, I think we're going to wrap it up for today. Remember, if you want to track how the broader market is handling all of this shocking news, go check out the Buffett Indicator app on iOS.
And remember, please conduct your own due diligence. This landscape is changing incredibly fast.
And for our full breakdown, all the charts and